Three markets, three continents, one invisible thread. And I spent the last 72 hours pulling filings, cross-referencing central bank data, and mapping capital flows to show you something that almost nobody is talking about right now. On January 1st, 2025, Russia stopped pumping gas through Ukraine to Europe, ending a 60-year energy relationship that survived the Cold War, the collapse of the Soviet Union, and even the first 3 years of the current military conflict. 3 days ago, the Federal Reserve cut rates for the third consecutive time, bringing the federal funds rate to 3.5 to 3.75%, its lowest level since late 2022. The vote split 9-3, with dissenters on both sides, some wanting to hold, others pushing for deeper cuts. Meanwhile, in China, oil demand just posted its first full-year decline in over a decade, down 1.2%, while copper inventories on the Shanghai Futures Exchange collapsed from 160,000 tons in March to just 26,800 tons by the end of September. That is an 83% drawdown in 6 months. These three facts look completely disconnected. A gas pipeline in Eastern Europe, an interest rate decision in Washington, a commodity drawdown in Shanghai. But here's what I found when I pulled the data. When I cross-referenced the IMF reports with the European Commission's energy assessments, when I mapped the Fed's dot plot against emerging market bond flows, when I lined up the physical copper inventory data against Chinese manufacturing utilization rates, there is a single combined trade emerging right now that connects all three. And the question is not whether it will work. The question is, who benefits if this trade breaks down? What is the real trigger that headlines are missing? And what hidden metric is smart money watching that tells you the timing before everyone else sees it? Those are the three doors we are going to open today. And I will not give you the full answer until we have examined every piece of evidence on the board. Think of this as a crime scene investigation where the victim is the old economic order and the suspects are scattered across 3 time zones. Let me start with the first evidence card. The headline everyone saw was simple. Europe survived another winter without Russian gas. Storage levels across the European Union hit 73% by mid-December, and Germany, the continent's largest gas consumer, reported inventories at nearly 80%. The European Commission released statements reassuring markets that diversification had worked, that the bloc was prepared, that the crisis was manageable. But here is where the surface story gets interesting, and this is the first place where you need to pay very close attention, because the detail I am about to share will come back at the end of this investigation in a way that changes the meaning of everything else. European wholesale gas prices have indeed fallen dramatically from their crisis peak of over €300 per megawatt hour in 2022. Today, the TTF benchmark, the tidal transfer facility in the Netherlands that serves as Europe's primary natural gas price reference, trades at just under $10 per million British thermal units, roughly twice the price of American gas at the Henry Hub facility in Louisiana. That spread, the difference between European and American natural gas, has collapsed from $12 at the start of 2025 to just $4.80, the lowest since May 2021. For context, during the peak of the energy crisis, that spread exceeded $90. Now you might think this is a sign that Europe has solved its energy problem, that the emergency LNG terminals Germany rushed to build, the floating storage and regasification units that came online in record time, the diversification to Norwegian and Qatari suppliers, all of it worked. You would be wrong. Because while wholesale prices have stabilized, retail prices for European households and businesses are still 2 to 4 times higher than their main trading partners. The European Commission's own report confirms this. German industrial electricity prices reached 16.65 cents per kilowatt hour as of July 2024. And industrial output for energy-intensive goods in Germany remains roughly 17% below pre-2022 levels. That is not a recession dip, that is not a cyclical adjustment, that is structural damage that has not healed after nearly 3 years. Chemical plants, metal producers, glass manufacturers, paper mills, the backbone of German industry, are operating at decade-low capacity utilization rates. Rod makers, which account for approximately half of China's copper product manufacturing and serve as a global benchmark for industrial activity, operated at just 61% capacity in October. That is down from 69% the year before, and the lowest seasonal performance in approximately 10 years of data collection. And here's the clue that most people miss, the detail that does not fit the narrative of European recovery. The European Commission just released its sixth report on energy prices and costs, published in February 2025, and buried in that report is a warning that few analysts have highlighted. Quote, "Energy prices in the EU remain structurally high compared to competitors, threatening the long-term competitiveness of European industry." End quote. The report notes that while wholesale prices receded, the EU's energy import bill still reached €427 billion in 2024, down from the peak of €604 billion in 2022, but still a significant drain on the European economy. Household gas prices were almost twice as high in 2023 as before the crisis. Industrial gas and electricity prices, while lower than during the crisis, remain 2 to 4 times higher than in the EU's main trading partners. Now remember door number 1. Who benefits if this breaks? Keep that question in mind because we are about to connect it to something happening 8,000 miles away, and the beneficiary is not who you might expect. If you have been finding value in this kind of forensic breakdown, where I pull the filings and connect the dots that mainstream financial media misses, this channel tracks the spreads and the capital flows that tell you what is happening before headlines catch up. Now let me take you to evidence card number 2. China's oil demand story, and why the world's most reliable growth engine just threw a rod. For over 2 decades, China was the force driving global commodity consumption. Between 2003 and 2023, China accounted for more than 50% of the growth in world oil demand, averaging 542,000 barrels per day of annual increases with an average annual growth rate of 5.8%. The International Energy Agency built its entire demand forecast model around the assumption that Chinese industrialization and urbanization would continue driving oil consumption higher. Oil majors, OPEC producers, pipeline operators, shippers, traders, everyone structured their businesses around the China growth thesis. But 2024 broke the pattern in a way that no major forecaster predicted. The country's crude oil imports fell to 11.1 million barrels per day, down from 11.3 million in 2023. That is a 2% decline, the first such drop in years at the world's largest crude importer. More importantly, fuel consumption tells an even starker story. Gasoline, diesel, jet fuel, the products refined from crude that actually power economic activity, these fell to 8.1 million barrels per day, 2.5% below 2021 levels. Think about what that means. We are not talking about a slowdown in growth. We are not talking about demand growth decelerating from 8% to 3%. We are talking about absolute demand destruction in what was supposed to be the world's most reliable growth market. The IEA now describes these developments in China as, quote, unprecedented, end quote. At 8.1 million barrels per day, China's consumption of oil-based fuels is 4 times less than all OECD member countries combined, which together have a population roughly equal to China's. Now here is where the data gets really interesting, and this is the part where I need you to pay close attention, because this connects directly to door number 2. The real trigger that headlines are missing. The trigger is not a recession. China's GDP is still growing at 4 to 5%. The trigger is not a temporary construction slowdown. It is something far more structural. The China National Petroleum Corporation's Research Institute, ETRI, projects that China's overall oil demand will peak in 2025. Some analysts, including researchers at Bloomberg NEF, believe it already peaked in 2024. The overall fossil fuel demand, according to ETRI, will peak in 2028, coinciding with the peak in energy-related carbon emissions. But while oil demand is falling, while diesel consumption for trucks and construction equipment is collapsing under the weight of the property sector crisis, something else is exploding in exactly the opposite direction. New energy vehicle sales in China surged 33% year over year in the first half of 2025, reaching 5.4 million units. In 2024, NEVs displaced 28 million tons of gasoline consumption in China, contributing to an estimated 3.1% decrease in gasoline demand. Solar capacity additions hit 212 gigawatts in the same period, nearly doubling compared to the prior year. Copper foil production, the thin sheets of copper used as current collectors in lithium-ion battery cells, reached 84% capacity utilization in October, the strongest performance in over 2 years, while every other copper fabrication segment operated at decade lows. You see the pattern emerging? China is not deindustrializing. It is not in terminal decline. It is reallocating capital, labor, and energy at a pace that the old commodity demand models cannot capture. The old China, the one that imported record amounts of crude to build highways and shopping malls, that powered its factories with coal and diesel, that consumed iron ore and cement at rates the world had never seen, that China is fading. The new China, the one Beijing explicitly calls the 3 new engines of industrial growth: batteries, solar panels, and electric vehicles. That China is accelerating. And the metal that powers all 3 of those engines, the metal that conducts electricity in every battery cell, every solar panel junction, every EV motor winding, every transmission line connecting renewable generation to the grid, is copper. Here's a quick test. Answer in the comments with one word. What do you think happens to copper prices when a country that consumes 60% of global refined copper shifts its demand from construction wiring, which is collapsing, to battery foil and grid infrastructure, which is exploding? Up or down? Just one word. Because the answer is not as obvious as it seems, and that brings us to evidence card number 3, where the data reveals something that challenged my assumptions when I first pulled the numbers. Let me show you what copper is actually doing right now, and why the physical market is sending a signal that price alone cannot capture. The benchmark 3-month copper price on the London Metal Exchange climbed to around $10,800 per metric ton as of early December, up 23% for the year. It touched its all-time high of $11,200 on October 29th. These are prices that only existed on 2 other trading days in the entire history of the LME. But here is the anomaly that very few people are discussing, and it is the kind of detail that separates surface-level analysis from deep market understanding. Chinese copper fabricators, the rod makers and wire producers that transform refined copper into finished products, operated at just 61% capacity in October. That is down from 69% the year before, and the lowest seasonal performance in approximately 10 years of data collection. Traditional demand from construction-related applications, electrical wiring for buildings, plumbing infrastructure, air conditioning units, HVAC components, all of it is collapsing under the weight of the property sector crisis that has erased trillions of dollars from Chinese real estate values. Yet copper prices keep climbing. How can prices reach all-time highs when the largest consumers' fabricators are running at decade-low utilization? The surface explanation that most analysts offer is supply disruption, and that explanation is partially correct. Glencore cut its production forecast for 2026. Ivanhoe Mines trimmed output expectations at the Kamoa-Kakula mine in the Democratic Republic of Congo earlier this month. Chilean giant Codelco, the world's largest copper producer, reported production down 7% in September. Rio Tinto raised its 2025 production forecast, citing developments at the Oyu Tolgoi mine in Mongolia. But that additional supply will take months to reach refineries. Treatment and refining charges, the fees smelters receive for processing copper concentrate into refined metal, collapsed from $53 per metric ton in January to negative $0.1 by late December. Negative. That is not a typo. That means smelters are now paying miners to get their hands on concentrate. That has never happened before in recorded data. That is how tight the supply picture has become on the raw material side. But supply disruption is only half the story, and honestly, it is the less interesting half. Remember, we still need to open door number 3. What hidden metric is smart money watching? What single indicator tells you whether this combined trade is working or breaking down? Here is where the investigation takes a turn, because the answer lies not in Shanghai or Frankfurt or in the mining pits of Chile and Congo. The answer lies in Washington, and it connects everything we have discussed so far into a single framework. Evidence card number 4 brings us back to the Federal Reserve and the most important price in global markets, the US dollar. 3 days ago, the Fed cut rates by 25 basis points for the third consecutive meeting. The federal funds rate now sits at 3.5 to 3.75%, its lowest level since November 2022. But the vote revealed deep divisions within the Federal Open Market Committee. The final tally was 9-3, with 3 dissenters voting different directions, something that has not happened since September 2019. Chicago Fed President Austin Goolsbee wanted rates unchanged. Kansas City Fed President Jeffrey Schmid also voted for a pause, arguing that inflation remains somewhat elevated and the labor market has not weakened enough to justify continued easing. Fed Governor Stephen Moran pushed in the opposite direction, advocating for a larger 50 basis point cut, concerned about downside risks to employment. The dot plot released after the meeting projects just one additional cut in 2026 and another in 2027, down from earlier expectations of multiple reductions next year. Chair Jerome Powell, at his post-meeting press conference, said the Fed is, quote, well-positioned to wait and see how the economy evolves, end quote. Markets are now pricing a 75.6% probability that rates stay unchanged at the January meeting. So on the surface, this looks hawkish. The cutting cycle is slowing down. The Fed is in no rush to deliver the 4 or 5 rate reductions that markets expected just a few months ago. But here is the hidden signal that I want you to focus on. Because this is the variable that connects copper in Shanghai to gas prices in Frankfurt to capital flows in Sao Paulo and Mumbai. The US dollar index has fallen approximately 10 to 11% year-to-date through September, marking its steepest decline since 1973. Despite the Fed's cautious language, despite the hawkish dot plot, despite the dissents from officials who wanted no cut at all, the greenback is experiencing one of its worst years in modern history. And when the dollar weakens, something mechanical happens to every dollar-denominated commodity on the planet, to every emerging market that borrowed in dollars, to every carry trade that uses low-yielding currencies to fund positions in high-yielding assets. Copper priced in dollars becomes cheaper for buyers using euros, yuan, or real. At $10,000 per ton, copper costs a Chinese buyer approximately 71,000 yuan. But if the dollar weakens 10% against the yuan, that same copper effectively drops to 64,000 yuan without any change in the dollar price. The same math applies to every importer in every currency. Emerging market currencies strengthen when the dollar weakens, easing debt burdens for countries that borrowed in dollars during the strong dollar years of 2022 and 2023. Countries like Brazil, South Africa, Indonesia, and Turkey suddenly find it cheaper to service their external obligations. Capital flows reverse direction. When the dollar was strengthening and US rates were rising, money poured into American assets, treasuries, tech stocks, anything denominated in the world's reserve currency. When the dollar weakens and US rates fall, that flow reverses. Capital moves out of treasuries and into higher-yielding assets in emerging markets. The carry trade, where investors borrow in low-yielding currencies to invest in high-yielding ones, comes roaring back. And here is the development that almost nobody in mainstream financial media is discussing. The preferred funding currency for that carry trade has shifted. It is no longer just the Japanese yen, which has been the traditional funding currency for decades because of the Bank of Japan's ultra-low rates. It is the US dollar itself. Dollar-funded carry trades in the Indonesian rupiah, Indian rupee, Brazilian real, Turkish lira, and South African rand are back in vogue. Fund managers from Neuberger Berman to Aberdeen to Vontobel are piling into these positions. In April alone, investors bought $8.92 billion worth of bonds in South Korea, India, Indonesia, Thailand, and Malaysia, the highest monthly inflow since August 2024. The MSCI Emerging Markets Index surged 33% in dollar terms through October, nearly double the S&P 500's return. The JP Morgan Emerging Markets Bond Index rose 13% in the same period. Now, you can understand this in 30 seconds. When the Fed cuts and the dollar weakens, three things happen simultaneously. First, commodities get cheaper in local currencies, so global demand rises. Second, emerging markets see reduced debt servicing costs and improved current account balances, so capital flows in seeking higher yields. Third, the interest rate differential between the US and the rest of the world narrows, removing the incentive for global investors to hold dollars and park money in treasuries. This is not theory. This is not a model projection. This is what the data shows happening right now in real time. And it connects directly to that hidden metric, door number 3, the one smart money is watching. But before I reveal what that metric is, I need to take you back to Europe, because the combined trade only works if you understand how all three pieces fit together and why the timing matters now more than at any point in the last 3 years. If you want to track this data as it develops, if you want to see the weekly spreads and flow numbers before they hit mainstream news, this channel is where I publish the evidence board that connects these dots. Now let me give you evidence card number 5, the European Industrial Competitiveness Gap, and explain why it is the missing link that completes the puzzle. I mentioned earlier that German industrial electricity prices are still elevated despite falling wholesale costs. But the consequences of that gap are only now becoming visible in the macro data, and they are worse than most analysts appreciate. Production in energy-intensive industrial branches in Germany has been declining almost continuously since early 2022. Chemicals, metals, glass, paper, ceramics, these sectors have not recovered. They are not recovering. The structural damage appears permanent unless energy costs return to pre-crisis levels, which no serious analyst expects to happen within the next 3 to 5 years. The chemical sector, which consumes 37% of Germany's industrial natural gas, has been particularly hard hit because of its technological reliance on gas as both a fuel and a feedstock. German chemical production does not just burn gas to generate heat. It uses gas molecules as raw materials to produce plastics, fertilizers, pharmaceuticals, and industrial chemicals. When gas prices doubled and tripled, the cost structure of the entire sector became uncompetitive against American and Asian producers with access to cheaper energy. This is not a German problem alone. The weakness in German manufacturing spills over to neighboring euro area economies through tightly integrated supply chains that took decades to build. When German auto production slows, suppliers in the Czech Republic, Slovakia, Poland, and Hungary feel the impact immediately. When German chemical output drops, downstream industries across the continent lose critical inputs. The Bank of Italy found that shocks in German industry significantly impact neighboring countries, and that Germany's greater trade openness means global demand weakness hits German manufacturers harder than their euro area peers. And here is where the story flips in a direction most analysts have not anticipated. And this is the moment where the three markets, three continents thesis comes together. The European Commission has outlined plans to completely eliminate Russian gas imports by 2027. Russian LNG and pipeline gas have already fallen from 45% of European supply in the pre-crisis years to just 13% in 2025. Starting at the end of 2026, LNG imports from Russia will face restrictions, and by autumn 2027, piped gas will be fully banned. That means Europe must source an additional 140 terawatt-hours annually from alternative suppliers. The primary candidates are American LNG, Norwegian pipeline gas, Qatari long-term contracts, and Azerbaijani pipeline supplies via Turkey. Every one of those alternatives trades at higher delivery costs than Russian pipeline gas used to provide. American LNG must be liquefied in Louisiana or Texas, shipped across the Atlantic, regasified at European terminals, and transported inland. That process adds significant costs compared to pipeline delivery from Siberia. Norwegian production is maxed out. Qatari contracts are long-term and priced at premiums. European industrial energy prices are structurally locked above historical norms for at least the next 2 to 3 years, possibly longer, regardless of what happens to wholesale benchmarks. So what happens to global manufacturing competitiveness when the world's third largest economy faces structurally higher energy costs, while its largest trading partner, China, is simultaneously pivoting away from energy-intensive construction and toward renewable energy manufacturing that competes directly with European industrial champions in solar panels, batteries, and electric vehicles? You are watching a manufacturing migration in slow motion. Energy-intensive industries that cannot pass costs to consumers because they face international competition are either cutting production in Europe or relocating capacity entirely. Where are they going? In some cases, the United States, which benefits from cheap domestic natural gas at the Henry Hub and has attracted significant industrial investment under the Inflation Reduction Act's clean energy subsidies. In other cases, China itself, which, despite its own challenges, has dramatically expanded renewable electricity generation and can offer lower power costs for certain applications. But the biggest winner in relative terms may be emerging markets with abundant energy resources, growing domestic demand, and labor cost advantages. Exactly the markets that benefit most from a weakening dollar and carry trade inflows. This is the combined trade. Dollar weakness drives commodity demand and emerging market inflows. European energy costs drive industrial migration and competitive pressure. Chinese reallocation drives copper demand toward electrification, while traditional construction demand collapses. 3 forces, 3 continents, 1 combined trade. And now I need to give you the skeptic corner, because every strong thesis has a counter-argument, and this one has several that deserve serious consideration. First, the bull case for Europe argues that EU gas storage is well-positioned. 73% is sufficient for a mild winter, and if LNG deliveries remain robust, prices should stay contained through the heating season. The European Commission has contingency plans, including supplies from Greek, Turkish, and Romanian gas via the Trans-Balkan route, Norwegian gas piped through Poland, and German assistance in distributing gas through Central Europe. Second, China's stimulus measures could still reignite traditional commodity demand. Beijing has signaled that boosting domestic consumption will be a priority in 2026. The consumer trade-in scheme has expanded to include more home appliances. Rate cuts and reserve requirement reductions are expected. The People's Bank of China has committed to maintaining, quote, appropriately lax, end quote, monetary conditions. If property stabilization gains traction, if developer defaults slow, if construction activity rebounds, copper demand from traditional applications could recover. Third, the Fed could reverse course. If inflation proves stickier than expected, or if the labor market strengthens more than current data suggests, the rate-cutting cycle could pause or even reverse. The September jobs report showed stronger than expected hiring, which prompted several economists to reduce their probability of a December cut to just 22% before the actual meeting. If the Fed signals that the cutting cycle is complete, the dollar could strengthen sharply, unwinding carry trades and pressuring commodity prices. These are real risks. I am not dismissing them. Any one of these scenarios could unfold and would change the trajectory of the combined trade. But here is where the objection becomes a clue, and this is the part that keeps me focused on the direction of travel rather than short-term noise. Notice that every one of these counter-arguments depends on timing. European storage is fine for this winter, but what about next winter, when Russian LNG is restricted and supplies must be fully replaced from more expensive sources? China's stimulus could work and property could stabilize, but the CNPC projects peak oil demand in 2025, meaning the structural shift toward electrification is accelerating, regardless of whether the property crisis moderates. The Fed could pause the cutting cycle, but the dollar's weakness has already triggered capital flow reversals and emerging market inflows that will take months to unwind, even if the next move is hawkish. The question is not whether these forces exist, The question is which force dominates in the next 12 to 18 months, and which assets are positioned on the right side of the combined trade. And that brings me to the hidden metric, the one I promised at the beginning. The answer to door number 3. Drop your answer in the comments. 2 words plus 1 reason. What do you think is the single indicator that best captures this combined trade? What metric would tell you whether China's demand shift, American rate policy, and European energy costs are all moving in the same direction? I will give you my answer in 30 seconds, but I want to hear your hypothesis first. Okay, here is what smart money is watching. It is not copper prices. Copper prices can move for dozens of reasons, from speculative positioning to ETF flows to short covering. It is not natural gas futures. Gas futures are too volatile, too weather-dependent, too subject to OPEC politics and LNG shipping bottlenecks. It is not the federal funds rate. The Fed rate moves slowly, in 25 basis point increments, with long gaps between meetings. The hidden metric is the Shanghai Futures Exchange copper inventory drawdown relative to LME and COMEX stock builds. Let me explain why this matters and why I have been tracking it weekly for the past 6 months. In a normal market, copper inventories move together across global exchanges. When demand rises everywhere, all warehouses draw down. When demand falls globally, inventories build at every location. The correlations are tight because copper is a fungible global commodity that flows to wherever demand is strongest. But 2025 has been anything but normal. Shanghai inventories collapsed by 83% from March to September, falling from 160,000 tons to under 27,000 tons. Meanwhile, LME inventories fell by about half, from around 280,000 tons to approximately 140,000 tons, and COMEX stocks actually built up to 330,000 tons as U.S. importers front-loaded purchases ahead of potential tariffs on refined copper. This divergence, this decoupling of normally correlated inventory movements, tells you something crucial that price alone cannot reveal. Physical copper is being pulled toward Asia, specifically toward the segments of Chinese manufacturing that are growing: batteries, solar, EVs, grid infrastructure, the 3 new engines, even as traditional demand from construction and appliances weakens. The old correlation between Chinese construction activity and copper prices is breaking down. A new correlation is emerging, one that ties copper directly to the energy transition and the electrification of transport and the build-out of renewable generation capacity. And here is why the timing matters more now than at any point in the last 3 years. LME copper recently crossed $11,000 for only the 3rd time in exchange history. The previous 2 instances were May 2024 and a brief spike in 2022. Each time, prices pulled back as demand could not sustain those levels and speculative positioning unwound. But this time, the structural drivers are different. Supply constraints are real and worsening. Treatment charges going negative is not a 1-month anomaly. It reflects a fundamental shortage of copper concentrate that will take years of mine development to address. The IEA projects copper demand will outstrip supply by the end of this decade, with a 30% supply shortfall by 2035. Meanwhile, every battery electric vehicle contains over 50 kilograms of copper, more than twice the amount in a conventional car. Offshore wind installations require up to 8 tons per megawatt. Data centers and 5G networks are massive electricity consumers, and electricity means copper for transmission, storage, and distribution. Now here is the rewatch moment. The plant I embedded at the beginning that pays off right now. Remember when I mentioned that treatment and refining charges went negative in December? That smelters were paying miners for concentrate instead of receiving fees for processing? That detail is the canary in the coal mine. When TCs go negative, it means the world's copper smelters, the facilities that transform raw ore into refined metal, are so desperate for raw material that they will accept losses just to keep their operations running. That signal has never appeared before in recorded data. It tells you that the supply side of the copper market is breaking down in ways that the price chart alone cannot capture. And it happened at the exact same moment that the Fed was cutting rates, the dollar was weakening, emerging market carry trades were surging, and European industrial competitiveness was eroding. Three signals, three continents, one combined trade. This is not coincidence. This is convergence. So let me give you the master key, the formula you can remember in one sentence and carry with you as you analyze markets over the coming year. When the dollar weakens, commodity demand in emerging markets rises because prices fall in local currencies and capital flows into higher-yielding assets. When European energy costs remain elevated, industrial output compresses and manufacturing capacity migrates to regions with cheaper power. When China reallocates from construction to electrification, copper demand accelerates precisely when global supply is constrained by underinvestment and production disruptions. That is the combined trade. Copper becomes the throughput bottleneck of the energy transition, while the currency regime supports higher commodity prices and pressures developed market manufacturing. The beneficiaries are emerging market exporters with mineral resources and energy transition supply chains. The casualties are energy-intensive European industries that cannot pass through costs and rely on stable export markets now facing competition from both American and Chinese producers with structural cost advantages. Now you might be asking, what do I do with this information? That is not for me to say. I do not give financial advice, and you should not make investment decisions based on a single analysis, no matter how detailed. Markets are complex systems with feedback loops and tail risks that can invalidate any thesis. But what I can tell you is this. The macro regime shifted in 2025. The Fed is cutting. The dollar is weakening. China is reallocating. Europe is struggling. And the physical market for the most important industrial metal of the energy transition just sent a distress signal in the form of negative treatment charges that has never appeared before. If you want to track the filings, the spreads, and the flow data as this story develops, this channel is where I will publish the next piece of evidence before headlines catch up. The China demand shift, American rate policy, and European energy crisis are not three separate stories. They are one combined trade. And once you see how the map connects Shanghai inventories to the dollar index, to German industrial output, to emerging market bond flows, you cannot unsee the pattern. The connections are there in the data for anyone willing to look. This is not financial advice. It is education and pattern recognition. Thanks for watching.